Hey everyone, Grayson Roze here with Stock Market Mastery. Recently, I joined my Tensile Trading co-author Gatis Roze, and we sat down with the American Association of Individual Investors, the AAII, for a very special three-part Family Day event. We were hosted jointly by the Los Angeles and San Diego chapters, and they asked us to come share our experience, more than 50 years of combined investing experience between the two of us, share how we approach the markets, how we manage our own money personally as individual investors, but also talk as a father-son team, as a father-son duo who has made investing a true family activity. Talk about how we've navigated that between the two of us, sort of across the generations, if you will. So we had a blast presenting this seminar. It was in three parts, each part about an hour long. Today, we're going to share with you one of those three parts. Now, we have all of them available up on our Stock Market Mastery YouTube channel, so you can always check out the full presentation by linking to all three of those parts back to back. Now, in the third part of our presentation, Gatis and I came back together from our individual talks, and we just sort of sat down for almost a little bit of a fireside chat to talk about passing the financial baton but still investing together. We talked a lot about how we have truly made investing a family activity between the two of us, how we think together, how we combine our perspectives across the generations into a more powerful investing philosophy, investing strategy for both of us. So we covered a lot. We had a blast taking some questions from the audience as well. Lots and lots of great discussion in the third part of our AAII segment. So here is Gatis and I sitting down together for part 3 of our very special Family Day event recently with the American Association of Individual Investors. Well, just to give everyone a quick sort of thought on how we structured this and how we thought it would go. In the third leg of today's seminar, what we really wanted to do was just talk together on screen at the same time about kind of passing the financial baton, how we invest together, the routines that we have together, the workflow that we've kind of found as not as investment partners in the sense that we're not managing the same accounts, but we are investing alongside each other and kind of leveraging each other as sort of co-investing buddies in some way. So we had a couple of just kind of conversation starters in this presentation for us to just kind of riff on together and discuss together, and then obviously take some questions at the end. So Gatis, Mr. Roze Sr.
Let me open by my first comment was that the title of my talk was a bit of a misnomer because it implied that it was just a one-way. And for those gray hairs that are listening to this and their offspring, I think it's pretty obvious after Grayson's presentation that this is very much two-way. And I've learned a great deal from Grayson, not just about what stock charts is doing and tools, but also one of the things going back to when he was at Swarthmore, he could maybe that really had a profound impact on my own investing was Grayson, you had that a professor that was known for the study about choices and narrowing down choices.
Yeah.
If you could maybe touch on that, because for me, that really had an impact and change.
Right. So I was fortunate to have a professor. His name was Barry Schwartz. He was kind of one of the preeminent figures in really thinking, judgment, and decision making were kind of his fields in psychology. And so he was actually a professor of mine. I took a class from him called Thinking, Judgment, and Decision Making. A little on the nose there. But he was also my sort of academic, academic advisor was what they called them. But again, that concept, kind of like what I was talking about with learning about supply and demand in economics classes and then applying them to the markets. I learned a lot about cognitive biases, or what we call them in psychology. How our brain is wired to think and make judgments and make decisions. And I thought about all of those things in the context of the financial market. So Gatis and I, especially when we wrote our book, when we talked about a lot of things like the investor self, talking about emotional control, discipline, there are all of these cognitive biases that we fall victim to just as humans. For instance, something as simple as you'll hear a lot of investors actually who've globbed onto this in behavioral finance talk about something called the endowment effect, which basically means that because you own something, because you don't even have to buy it, just because you have something, you place more. You've been endowed with that item, whether it's a stock or a coffee mug or whatever it is. You've been endowed with that item, and so you place more value on it just because it is yours. You ascribe some ownership to it, and you're sort of misled by this endowment effect that means I own it, therefore it's valuable, therefore I can't sell it, and I don't want to part with it. So when you think about that in the context of the stock market, a lot of people struggle to sell stocks because they bought it and they own it and it's theirs now. When in reality, if a stock starts to underperform, if the trend starts to reverse, if the thing is going down and you're losing money, you just need to get out of it. You don't own an item that's personally attached to you. It's just a stock and it's just a number on a screen at this point. So, thinking about those cognitive biases in the context of investing, we've written articles about this. There's actually a stock charts article that lists a lot of them and how they apply to the markets. But yeah,
I was thinking of the I think you called it the paradox of choice, where if you could sort of summarize that in a minute, just about how important it is to narrow down your choices. And I think in the stock market, there are just so many choices. How do we narrow it down to a manageable universe?
Yeah.
And I think the paradox of choice was a good example.
Yeah. So for everyone listening, go look up a book called The Paradox of Choice by Barry Schwartz. It's got a yellow cover. I probably got it actually on the shelf behind me. But he wrote this book, and he's also done a really beautiful TED Talk on this, actually. It's from many years ago now, but you can find it on YouTube. But go look up the Barry Schwartz Paradox of Choice. A lot of investors actually have globbed onto this book as a beautiful investing book. But because what he talks about is the impact of excessive choice. We've been conditioned in the modern world. We've given everyone infinite choices in everything. He talks about this specifically. You go to buy cookies or something at the grocery store, and you think there's going to be like two choices. You just want either chocolate chip or oatmeal raisin or whatever. If you walk down the cookie aisle these days, or the chip aisle, or the jam aisle, I mean, there are dozens and dozens and dozens of choices to choose from. And so you end up staring at this wall of jams, for instance, going, I don't know which one to buy. And I'm going to be terribly unhappy with any one that I end up buying, because I'm going to be thinking about, this one might not be as good as that other one that I passed up, though. So he talks a lot about how excessive choice and high choice environments have actually led to this thing called choice overload, where you end up unsatisfied by any choice that you make, because you're always thinking about basically the opportunity cost of it, whether or not you made the right choice. When you think about that in the context of investing, ETFs are great, stocks are great, but there are thousands and thousands and thousands of securities out there that you can buy. And now when we think about the investable universe expanding even more with cryptocurrencies, with all the derivative products, everything that's out there, I mean, your choice is truly infinite. So when I talked about in my presentation, I talked a little bit about filtering things down and trying to actually shrink down my investable universe and find reasons to stop considering things.
And that was my point.
That
was the point that had a pretty profound impact on me. I no longer, for example, when in my young crazy youth, I did options and futures, and I no longer do that. I don't use leverage at all. My choices, I've narrowed down my own choices to a universe. For example, the stocks that I buy, Grayson, you buy mid caps. I don't buy mid caps or small caps or micro cap. I only buy large cap stocks.
Right.
And then with ETFs and mutual funds, I have this. I pick a sector or a particular asset class, and I buy what's called best of breed. Yeah. So I'm letting, like Grayson talked about in the previous, pick a biotech. Can I find mutual funds that have outperformed, or am I fine with an ETF? Well, in biotech, Grayson and I have owned XBI for a long, long time, because we haven't found mutual funds that can outperform it. So why pay the damn fees?
Well,
So
and I would,
that this whole idea of choice is important. And looking at this slide here in front of us, he and I have a standing status,
every Monday,
like standing Zoom meeting once a week at a very particular time. And we review, just talk generally about what's happening. And I think that's
what we're both
it's
doing.
nice to get into that routine.
Yeah. And I think, especially because like you were saying in your talk, sort of removing the taboo of the money talks and stuff.
Yeah.
I think that our family has been really good at that over the years, and it's made a defined impact on me, on us together though as well. But because we've removed that taboo talk, we do have this kind of weekly status strategy session round table. I don't even know what to call it. Sometimes we open a bottle of wine, and if we do it in person in non-COVID times, we can open a bottle of wine and have a glass of wine and talk about the markets. Other times we've got the screen sharing going, and we're actually looking at charts and trades and ideas and stuff like that. But it's been really healthy just to be able to have those conversations openly and be able to bounce. For me, and I think for you as well, to be able to bounce ideas off of you, get your perspective. You do the same with me. I give you my perspective. It's been helpful.
Well, Grayson, do you think you could go to you want to work through the slides or go to the TAD slide? Because I think that
Sure.
would be a nice.
We can flip around in here. So
the TADs, well, this I taught. Here's something I call TADs, and it touches upon what Grayson was saying about the status roundtable that we have. I think it's really important when parents are talking to their family, whether it's spouse or kids or grandkids, to sort of follow this little paradigm. And it's T simply means, listen to the other person, tune in, understand what the other person is saying, and have a two-way dialogue. A is, be flexible. Understand that the other person's financial inclinations and abilities are different than yours. And I think Grayson and I have provided a reasonable dichotomy here to show you that, a 27-year-old and a gray hair are not the same thing. And then D for dignity, be really careful not to judge the other person's behavior as good or bad, or discuss, they'll have choices that you don't agree with. Try to respect that with sort of understanding and patience. And then finally, S was try to settle on a mutual solution. It doesn't need to be perfect. It's okay. It's fine to take little tiny steps. And, Grayson and I we worked on a car together. We have a little Honda S2000 from his high school days. When he's working on that, I always found that he was open to talk about money and investing, but he's working on the car. So when that opportunity presents itself, try to grab it. Sometimes trying to sit down with a 16-year-old and say, okay, we're going to talk about money and investing, that doesn't go. So you've got to be sort of opportunistic, if you will.
I think also just to add on that really quick, framing those conversations in something that's going to be attractive to who you're talking to. So, to put some color on that, like when we were having these conversations about investing and saving and why money mattered and what the stock market was, like the fact that it could be framed in, you spend all of your time every weekend trying to get mom and I to go take you to Zoomies to spend money on clothes. Why don't we buy that stock? You clearly like the company. You're clearly interested in it. Why don't we buy that stock? That kind of framed it in my mind as like something that was related to me, instead of it just being this mathematical conversation about like saving is important because compounding makes sense. I got that stuff later, but I got hooked into it basically because I had this initial, like, more personally relatable kind of thing that hooked me in. So then I was more open to those bigger conversations and the kind of the more for lack of a better word, probably boring conversations. Later on, I was more interested in that because I sort of was already hooked in.
Well, you made an interesting point, Grayson, earlier that I'd never heard you say, and it really struck home with me. Is that had I, when you were 12 years old, had I been throwing my MBA income statements and balance sheets at you and said, "Hey, here's stuff you should get
Yeah.
interested in," you would have, my God, chucked your cookies all over my balance sheet. But the idea that understanding something simple, you're 10 years old and I'm showing you how to draw trend lines, that was a simple hook. And
Yeah.
yay for technicals, yay for charting.
Well, and it also gave me a way to bring things to you too, because, again, as a 12-year-old kid, finding that, especially back then, like I mentioned, finding that more obscure fundamental data was a little bit hard. Well, was very hard. And it wasn't super readily available to a kid like me to dig through, random websites and stuff. But you could point me to stock charts or, whatever the platform was. At that point, we used stock charts, which is fun because I ended up going on to work for them. But you could point me to stock charts and say, here's one place to go, find some charts, go nuts. And so I would then start bringing you charts because I had a way to actually see things, and it made it approachable for me. And so I could actually bring stuff back to you, and then we could have a discussion. And so it gave me, an easier way to participate, to get involved, to understand what was happening. Yeah.
I'd like to actually digress a little bit and answer the question that was posed to you about why are we such growth investors and we don't own value. Just briefly to address that.
Sure.
I mean, we haven't. I don't think you own it anymore, but I still own the Ochman Fund, which is a value fund. And when you own VTI, VTI has a lot of value stocks in that bundle.
That's true.
So when you buy an ETF, you're buying a basket of stocks. So we do own value. It's just we choose not to focus on value.
Yeah. Yeah. No, that is a good point. It's included in some of the other things.
Right.
Yeah. And what's not included too in that super core bucket is I do have a chunk of the portfolio that is just in VTI. I include that in the super core sort of allocation. But there are times when the growth stocks are getting hit, as they were a couple of months ago. And so I've got some new money that comes in, let's say, and instead of putting it into those, I'll say, well, this time around, I'll put some more money into VTI. And it's always a reasonable strategy that's going to pay off, 40 years from now. I made that joke.
The point is, a lot of people are lazy.
So I made that joke with a buddy of mine recently. He was trying to figure out what to do with his money, and he was kind of doing the thing that Gatis and I see all the time. He was going straight to, I want to buy individual stocks. I want to buy
GameStop.
Yeah. And so, I stopped him and I said, if you don't have sort of a structure, a core structure before you start doing that, you're probably going to get kicked out of a lot of these things. It's not a long-term strategy. You're not doing, the necessary steps to build wealth over time. Why don't you just go take a chunk of money and buy VTI? And then call me in 40 years and you can buy me a car or something, because you probably have enough to do that. And it was like, and so he did. And he's actually, that was a while ago. And he's been really grateful that he did it. But for him, it was an incredibly simple strategy, because it was like, here's this one low cost ETF that's just going to get you into the market. And ultimately, that's a fantastic starting place, or even an ending place for like 98% of people. So, yeah.
For those of you out there, individual investors that are Vanguard clients, maybe it's available if you Google it, but Vanguard just put out a study of looking at their investors, and it covers 2015 to 2019. The sample size is 5 million investors. And it's a long-term look of how their clients invest and what works and what doesn't. And I don't want to get into the study. I have it here in front of me, but it was very interesting to read some of the conclusions, and I would encourage the listeners to check it out, because it does talk about generational investing, and you can see sort of the differences between millennials and gray hairs. But anyway, next question.
Yeah, you got to be careful with that gray hair thing too. I'm trying to sit as far away from the camera as I can, because if I get too close, everyone's going to see that I got my gray hairs coming in here on the side of my head. So thanks. Gray hairs. Yeah.
Okay. Well, I'm just proud I still have hair.
We put this up, Dad. What works when navigating family finance? I think we've touched on a couple of these points, but maybe for a couple of minutes before we take some questions. What do you think works when navigating family finance? What has worked for us?
I think just dialogue. I mean, the fact that you said something at one of the boot camps that, Mercer Island's a pretty affluent area, and a lot of the dad's parents didn't have dinner with their kids because they were working till 8 o'clock at night. But we were always together, the three of us, for dinner, because the stock market closes here in Seattle, and I went to your lacrosse games, and we would discuss. My wife is a Harvard economist and a Stanford MBA, and you can imagine poor little Grayson had to listen to the two of us from the time he was 5 years old around the dinner table. And so I think it gets back to that concern I had about the taboos of money. You got to overcome that at the dinner table. It's okay to talk about money and investing in the stock market and the Wall Street Journal article you read. And it shouldn't be taboo.
Yeah. I think dialogue, like we said, kind of breaking down that taboo. I mean, I think the other thing is trying to share perspectives. So I think one of the things that Zoomies experience that I had, with you when I was a young kid, one of the things that did was it kind of meant that you were asking me a question, or you were bringing my perspective, my experience, my preferences into this financial conversation. So instead of you saying like, we should buy GE together or something like that, or Ford, I was kind of like, well, I don't know, I'm not interested in that. But because you brought my perspective into the conversation, that opened the door for me to, share my thoughts, share my perspective. And I think that's gone forward. And so now when I look at us having those, those Monday meetings together, there's a lot of shared perspective back and forth. And it's not a one-way conversation. It's not like Dad saying, you need to buy this group of stocks in these 3 ETFs. It's the two of us saying, well, what are you buying? What are you seeing? Do you have any ideas? What's working for you? What's not working for you? It becomes more of a collaboration. I don't think you did that intentionally with that Zoomies thing. It was just kind of a way to get the conversation going, but it ended up having, I think, a long-term impact.
One thing that was pivotal in my thinking too was in 2019, I took a trip to Japan, and on our trip, it was a Stanford travel trip. There was a woman that had worked, she had just retired from 35 years working in a very famous family office that had hundreds and hundreds of kids, millennials and whatnot, that were very wealthy because of a very long-term situation with the family. And she made a comment. She said, the kids at 25, the kids are the way they're going to be. And so if they're not capable of managing money, don't expect them to change. But if they're on the right track and they are responsible, and then go ahead, involve them in the family business, and trust that they'll grow as, little money managers and little asset allocators. And that had a pretty profound effect. Obviously, with Grayson's case, we started a lot earlier, but and he turned out pretty well. I mean, the jury's still out, but so it was, the 25 was an interesting demarcation zone for what she told me from her experience.
Yeah. Okay. So the flip side that we had up there was what doesn't work when navigating family finance. I mean, it's kind of funny because I think you can just say the reverse of everything that we just said works. doesn't work. Having those conversations be taboo, having everything be one-sided, that kind of thing. But what else doesn't work when navigating family finance? What do you think?
If you don't, when you're younger, you have to wrap these narratives in stories. That's why I touched earlier on playing board games. Like, okay, Monopoly is something that we played as a family that does teach some, very simple sorts of things. You can't beat somebody over the shoulder. You've got to sort of jump on it with the opportunity, as I said, when it
Yeah.
presents itself in a comfortable environment. You got to jump on it, but you have to make the effort, and you have to be candid. You yourself, the parents, have to be able to talk amongst themselves. Have to be able to look in the mirror and say, "Look, these are my strengths and weaknesses, and Grayson, here are some losses, some real losers, some stupid things that I
Yeah.
did. I'm very candid about that. And here's some stuff that, over time has proven to be very good." So it's that brutal honesty, and the kids sense that, and they'll respect you for it and embrace your message. Your message will have more adhesiveness
Yeah.
with the kids.
Yeah. And I think what I would add to that is not being too rigid in those conversations. I think not being too boring, cut and dry, mathematical with the lessons and things like that. Finding ways to make it fun.
If you think it's numbers, you think money and investing is all about numbers, you got it wrong. It's not.
Yeah,
It's
I
about
think that was something that
values
we
and
got to share. Yeah, that was something that we got to share. When I was learning lessons growing up and things like that. But the other thing too is that because you were an active investor and you were pretty open about like, I bought this stock, it totally went against me and I had to get out of it, and I took a loss on it. We had that dialogue about not everything is going to work out. Investing is not about 100%, probability of success. It's if you can be successful with 51% of your trades, you're going to be incredibly well off. So I think the fact that we had open conversations about mistakes, learning lessons, how to take those lessons forward with you and benefit from them. We talk a lot in our courses in the book and things like that about how the benefit, at the end of the day, the real benefit of a trading journal is that you're writing things down for yourself, and you can then go back through your own personal history, read up on it, and learn lessons from it. We had good conversations about that. And I've said this to a lot of people, especially recently, because the question has been asked a lot. What do you think about the GameStop nonsense and how crazy all the GameStop madness has been? And I've said, I am actually thrilled to see it happen, because on one hand, I am totally terrified by the fact that this happened. And it's just clearly illogical, and it represents some sort of corner of the market that's broken. But at the same time, if this creates a younger generation that's had some exposure to the markets, they've gotten involved, they've learned what a stock is, they've seen how you can make money. I hope that translates down the road to all of those kids that are 18 and they bought GameStop stock on Robinhood or whatever because it was trending on TikTok. I hope that translates for those kids to, okay, well, now the madness is over, but I'm still interested in the stock market. I'm going to start to learn more about this and get involved in things. And I think it will translate to a generation that's more open to learning about this stuff, more open to what the stock market is. The same with crypto. I think, on one hand, it's wild, but at the same time, I hope that it actually is creating a generation of people that are interested in taking control of their own money. And I think that the barriers are only getting lower with things like Robinhood, with zero commission trading, with more platforms more brokerages and everything than ever before to trade on. So I think that's actually good. And when I root that back to us, Gatis, to wrap this thought up, when I root that back to us, the fact that our conversations weren't, you can never make a mistake. If you make any mistake, it's going to be horrible. You got to start now and don't make any mistakes. The conversation we had was like, you should start now because you can make tons of mistakes and it's going to be totally fine. You're going to be all right. That's a lot healthier as a conversation. And that opened me up to the dialogue with you, because it seemed like, oh, if I get started now, it's something fun to get involved in, and I can make some mistakes and it's not the end of the world. So I think that was healthier. So
I think we should go to some questions. We've only got about 10 minutes left. We could listen to you guys talk for another 10 minutes, but we've got a lot of really good questions. And
Let's do it.
I'd love to ask this one. Tish Hanwinkle writes, how do you get a child who doesn't like to save interested in investing or saving? Kids and young adults love instant gratification.
It's true. So
Grayson, tell them the story about your buddies that would all go to McDonald's to buy get the kiddies prize or whatever, and you said, no, I'm saving for my car.
yeah, so I did have this experience. I mean, for me, it was, I loved cars. Like I mentioned, I sort of said this story earlier, but I loved cars. I wanted a car from the time I was like 7 years old. I was obsessed with what car I was going to drive and everything. I just always loved cars. Bad habit now because it gets more expensive the older you get. But I loved cars. I made a deal with my dad when I was actually around the same time. I was about 10 years old. And I said, I want to buy a car when I'm 16. My parents said, we will pay for 1/3, but you got to pay for the other 2/3. So I spent that 6 years from 10 to 16 trying to figure out how I was going to save enough money to pay for 2/3 of this, dream car. I think the fact that I had a mission, I had a goal, the conversation wasn't about saving for retirement or saving so that I could have money for some big thing that I didn't really want or understand or something. The fact that it was start saving so that you can spend everything that you save on a car. I worked really hard towards that goal for 6 years. And then by the time I actually got there, I ended up not spending everything on the car because I was like, well, dang, I spent so much time saving and I don't want to waste it all. I mean, maybe I can keep saving and get a better car down the road. So it sort of kickstarted that because it gave me a mission. It put saving into sort of a mission with an endpoint as opposed to this nebulous concept of you got to save because it's the right thing to do.
Yeah. Save for retirement. You're 12 years old. You got to save for retirement.
Yeah.
So the fact that you had a goal, that's what drove you into saving, Grayson, that when your father planted the seed about the car.
Yeah. And I think if you can get the sort of the bug bite in there, if you can get bitten with the bug of saving for something, I think that actually translates to saving as a habit.
Okay. Next question. Our audience is composed of a lot of retirees. And today we talked a lot about the core portfolio structure of investing. What would you suggest for protection against a drawdown like we had last March? Mm-hmm. So people are protected and they don't have to, cash equities when they're down. What counsel or advice would you give people that have a 20-year plus retirement window?
Mm-hmm.
One of the tricks that we've used ourselves when, we're pretty serious real estate investors is when you look at the dividends that are paid out by these either stocks or ETFs or mutual funds, you can it's a switch, whether you're at TD Ameritrade, Fidelity, Schwab, or Vanguard, you can turn that on and off.
Dividend reinvestment.
To get the distributions coming to you as cash, depending upon how much you need. But as a solution to say, oh my God, the sky's falling, I have to sell that because I need money or whatever, it's just not a great strategy. And I have to confess, I'm not a big bond person. I think my bond positions are about 5% at most of my portfolios. So I'm in a different boat.
Do you recommend 5% for most people? I mean, or you're an exceptional investor with exceptional
Fred,
high risk tolerance.
I don't think when it comes to bonds, I was a 4-time entrepreneur, retired young. I mean, I've just never gotten into bonds. It's just, I've never needed to. And I don't know, Grayson, I don't think Grayson owns any bonds.
No, I mean, I'd rather go after some sort of dividend growth type of corners of the stock.
Grayson, but you're working, you're not retired. You're not having to draw down your portfolio.
Right.
Our audience is in a different mindset.
But I hope that comes through too. I mean, the fact that my perspective is based on the fact that I've got this, 40 plus year investing time frame. So the closer that you get to retirement age, let's say, the more that I have to shift away from the high growth corners and the VTI. I can't own VTI forever. Right now it makes sense. That's a reasonable strategy, but the closer I get to retirement age, the less valid that is. So,
Okay.
it shifts.
But my point, Fred, was simply go back and take a look. Don't panic sell. Go back and take a look at your positions and think of it like a switch. You can turn on and off the reinvestment of dividends and capital distributions and all that, and just turn on whatever you need to live.
Okay.
But keep that money in the market and keep it growing.
I've got one more question, then I'm going to let Ryan ask a couple questions. This is a question for Grayson. Can you talk about how IRAs, Roth IRAs, regular traditional IRAs fit into your game plan right now?
Yeah, it's a good question. I probably should have led with that, but max them out. I mean, take advantage of everything that you can. I'm very, very blessed to have a great matching program at the company that I work for. So I take full advantage of that. I make sure that I'm taking full advantage of the matching program for my 401k. I personally, I am again blessed to be in a position where I can max out my 401k contributions and my IRA contributions. So I try to max that stuff out as much as I can. The concept, is the same. I'm in those accounts, I'm putting 100% of them basically into the 401k is obviously a little different because I have specific funds that I can buy or sell. But I try to get as close to that kind of super core concept as possible. Those two portfolios, my IRA and my 401k, I bucket those into my super core big bucket, if that makes sense. So they're basically 100% invested in the ultra long-term, set it and forget it, watch it grow type of accounts that we were looking at before, or funds that we were looking at before.
And Fred, I really would like to applaud Grayson because he did embrace the idea, the power of compounding and tax-free investing. And, most younger people would say, well, okay, I'll put a bit of money into that. But as he just said, he's maxing it out, and it's already, the growth is absurd. I mean, compounding is just an absurd concept.
I will say also, actually in that choice overload book, the Paradox of Choice book, I think that Barry talks about, I don't remember if it was in the book or the TED Talk, but somewhere he does talk about actually 401ks and mutual funds. And basically they did this study. I think it was either Vanguard or Fidelity or something did this study, and they found that for every 10 additional mutual funds that they add to a program, basically every 10 options that you give someone, I might be getting the numbers wrong, but every 10 additional options you give potential 401k contributors, the chance that they're going to participate goes down by like 10% or something. And so by the time that a 401k program, it seems like it's a great thing to offer 50 funds, but by the time you do that, you've actually convinced 50% of people that it's too much work to figure out what to invest in. And so that, 50% of the people end up just giving up the money because it's too much work to figure out which of the 50 funds they want to invest in. So it's interesting to think about choice overload in some of those 401ks. I think the work that you can do if you're young and you started a new company and they've got a 401k program, especially if it's a matching program, the work that you do to just pick, the sort of highest returning funds on average and just go for them. You can always change it, but get that money invested, start to take advantage of it, put it to work for you. I've definitely made a point to do that in my life. So.
Okay. Ryan, why don't you unmute yourself? There you go. Good.
Thank you, Fred. I think you're getting close to finishing time, so maybe just sneak in one more question here. We'll see how it goes. But we've touched on some of these issues, but question here on how do you teach younger generation that the stock market's not a get-rich-quick scheme and to be able to handle the downside? Grayson, you mentioned 51% success rate's probably pretty good in the market. So are there specific things we can do or say to help people with the 49% of the time when it's not working out as hoped?
Yeah. I think the conversation has to start with those long-term views, looking at a 100-year chart, a 50-year chart, things like that, showing that the slow and steady, combine that with a compound interest calculator. I'm constantly trying to get people to just go play around with a compound interest calculator. There are a ton of them out there on NerdWallet, and there's one on the government's website, like investor.gov or something. But if you can get a kid to just pull up a compound interest calculator and play around with it. Just type in random numbers and different rates of return and just spend a little bit of time seeing the impact of compound interest. I think that is what tells you that the stock market has a lot of power beneath the surface. That's not just single stock, get rich quick scheme type of things. So I constantly try to get people to go look at those, but start with that longer term view. Also maybe highlight also some charts. It's starting to change now, but there are plenty of charts that have plenty of companies, individual stocks that have never regained their highs from, the pre-2007 crash. So pull up some of those examples and show off how, you think that you're calling a bottom, but the bottom might be a long ways off. Ultimately investing in the total pie for a long period of time is really how the money comes.
I know people don't want to hear this, Ryan, but they don't need to buy stocks. The first step is, back to that super core. I know it's sexy to talk about stocks at cocktail parties and with your friends and Grayson's example with Zoomies, but it's perfectly fine to buy a basket of stocks. I mean, XBI would be a great basket right now to buy and explain to your kid, hey, you own all the major biotech companies in this little basket, one share XBI.
And that's, goes back to the VTI thing of if you're 20 years old and you just buy VTI and you hold it for 40 years, that's a perfectly reasonable decision that you are going to be thrilled with 40 years from now. So start with that. Start with the basic, easy stuff. That's the great thing about, to me, that's the great thing about ETFs is that they've lowered the bar. They've made investing like that really so much easier and so much cheaper too.
Thank you. We'll just have one more one. And I know that for some people, we didn't get around to your questions, but as mentioned, stockmarketmastery.com, you can continue the conversation there for those of you who are disappointed if we didn't get around to your questions. This one I'll just read to you word for word because I'm not sure I have it completely, but it was an earlier one I wanted to make sure I didn't miss. Question writes, William Bernstein talked about when you've won the game, stop playing. John Bogle wrote a book about the idea of enough. How do each of you view these ideas?
That's a good question. I can take it really quick, Dad, if you want. I think over time, that's how the shifting percentages, when we look at super core, and explore, they probably do start to shift down at some point, and the super core becomes even bigger, the core becomes even bigger, and the explorer, becomes almost nothing. That's a really interesting question. I don't think that the market has a top. If you believe in humanity and if you believe in society growing and the inventiveness of the human spirit, I don't think that the market will ever have a top. So, in my lifetime, is the market going to really reach a top and I should stop investing because enough is enough? I don't know. I mean, I think my ETF exposure to those super core positions and things like that grows, and we'll see where that goes in a lifetime. But I don't know. Hopefully that answered it to some extent.
From Silicon Valley, I'll tell you, there is no such thing as enough's enough, because I had many discussions with friends that they would say, okay, when I hit 20 million, I'm going to retire. And then they hit 20 million. I said, well, no, when I hit 50 million. And then it's like when I hit, and I had a friend that hit 1 billion and went all the way back down to 100 million. So, when's enough? There is no enough. I chose to walk away, after when I was about 40, I was burned out. I had been burning the candle at both ends. And I can't say that I retired. I took up a new career, and
I'm just adding to that super quick before we wrap up. I think actually, Dad, now that I think about it, you're almost an interesting example where it's not the money, it's not the value, it's the stress, it's how much energy and effort you have to put into it. So you probably have hit a point, actually, if you think about it, early in your career, you did a lot of stock investing. I would constantly talk to you about the individual stocks you were buying. And now you've almost stopped buying individual stocks. You have a very small bucket of individual stocks. And so you've reached a point probably where you think that the lower stress of, ETFs, longer term positions, that kind of thing is worth it for you because you can. I'm still the crazy guy who I'm a total stock junkie. So I just love following individual stocks and buying individual stocks and stuff. But I think that's where the enough comes in. You get to a point where you say, I don't have to deal with the stress of individual positions that are, much more volatile and things like that.
There's a famous quote from Jesse Livermore that said he said, it wasn't my trading that made me my millions. And Jesse Livermore's in the 20s. He said, it was my sitting.
Yeah.
And why should I trade Microsoft and Visa and MasterCard and Amazon? And they've been so good to me. It's like, I don't want to trade them. Yeah. Anyway.
Yeah. Well, thank you very much. I want to thank both of you for a very interesting session on behalf of San Diego, and I'll turn it over to Fred to wrap up the session. Thanks, Fred.